Bring in Joseph Quinlan. He's chief market strategist over at U.S. Trust. Joe, just looking at my notes here, I mean, you're just back from India. You know, we're watching these emerging market economies very closely. I'm curious what you saw.
Well, you know, I saw a lot of consumption amongst the middle class, a lot of infrastructure build out. There's a lot of fiscal stimulus. So when you go to India and China, they say crisis, what crisis? In the sense that they're still growing by 8% plus. That might come off a little bit here, but they're pretty optimistic, you know, in the emerging markets.
But you saw, I mean, you noted that outflows were important there. Do we make it interesting for them to put their money here? I mean, are they intrigued by our markets, or are low rates here not helping much?
You know, what they really want to buy are companies, the physical assets, less paper and more physical assets. And I think they're a little timid there. They're worried about some U.S. protectionism. So I think, you know, if they're sniffing around and they're looking to buy U.S. assets, it's more on the corporate side, the companies, as opposed to treasuries.
Hey, Joe, going back to today's trade, we're talking with Matt Shapiro, who's out in Chicago. I mean, what do you make of the kind of activity we're seeing today? We're up for a second day here on the S&P, the major equity averages. Nice move up, actually, today. Anything kind of catching your attention on a day when we've got some mixed economic news and some other things going on?
Well, I think investors, and rightly so, are looking through all the noise about the weather, any type of slowdown here, because I do think the first quarter GDP number will be pretty robust. And I think in the fourth quarter number, capital expenditures were quite robust. So companies are investing. They're going to start hiring. So I do think, you know, we're looking for an S&P target at the end of the year, 1250, 1300. So we see more upward movement as well.
Hey, Joe, you know, who knows how or if anything will play out here with New York Times, but in general, we are seeing some more deal flow. As a matter of fact, Matt and I had a guest on who talked about expecting this to be a record year for M&A. Exactly. A good sign, strong sign for the market.
Absolutely. It tells you that the animal spirits are back, that the CEOs have confidence, that they have the liquidity as well to do the deals, whether it's through earnings or borrowing. So it's a very positive sign. I don't know if we'll see record deals, but it's much better than, say, 08 and 09, unequivocally.
Joe, what do you think? There is apparently plenty of dry powder out there. Do you think valuations are cheap, like Matt?
Well, I think they're attractive. They might not be as cheap as they were 6 months ago, but they're attractive, not only in the United States, but in Europe. I think you're going to see the problems there result in some more M&A attractiveness, and also in the emerging market. So it's a light years from where we were a year ago, of course. So this is a positive sign for the markets.
With your clients right now, I mean, what's the strategy you're advising?
Well, Carol, they're finally putting some money to work. So I think they're stepping back into the money, and they're looking at equities. I mean, they looked at cash and then fixed income. They're looking at equities, and within equities, large cap stocks seems the place to go. The dividend payers, the companies that are leveraged to global growth, kind of the familiar names that they lost track of or had no exposure. So they're coming back, but into the large cap stocks.
And you like more U.S. exposure versus exposure overseas?
Right now, we're seeing more U.S. exposure, yes. Kind of some folks are taking some money off the table with the emerging markets if they participated in the rally and rotating back into information technology, energy, and industrials here in the States.
Hey, Joe, let me ask you about, you seem bullish here on the U.S. market. You're bullish on emerging markets. You like what you saw in India, and you're excited about China. What about Europe there? I mean, the problems in Greece, although most people expect them to be solved, must loom large, especially if you look at the debt of other, even larger, more developed nations over there.
Yeah, that's right, Matt. We're seeing people pull back and kind of question their, particularly on the debt side, Europe. But remember, as the euro has weakened here, that's going to do a lot for the large cap German capital exporters. So we see some silver lining in the large cap French, German stocks, the Scandinavian countries as well. But in general, there's more money coming out than going in Europe right now.
Well, I'm guessing you'd agree here. In your note today, you say the bear case for U.S. equities and the U.S. economy pivots around a stubbornly high U.S. unemployment rate. Does that get solved? Does it need to get solved? Because we're looking at an uptick, at least the consensus is for an uptick again on Friday.
Yeah, Matt, we have to have some resolution with the unemployment rate. But what I look at is simply this. When you look at the unemployment rate amongst our skilled labor force, and that's someone with a 4-year degree, and you can argue whether that's a good benchmark or not, but right now, our skilled labor pool, right now, 95% employed. The unemployment rate, in other words, of our skilled labor pool is 4.9%. It's half the national average. These are the folks that are out spending. They're in the restaurants and traveling. So I know at the other end, unskilled labor, the unemployment rate's closer to 15%. That's going to be the headline grabbing number. But pay attention to the folks who have the income and the jobs. So it's a very bifurcated job performance that lends itself to stronger than expected growth down the line.
All right. Hey, Joe, thanks so much for joining us. Joe Quinlan there, Chief Market Strategist from U.S. Trust, Bank of America, Private Wealth Management.